Welcome to the next module of the Trading Den. In this one, we will be going over LR, which equals low resistance liquidity run. Low resistance liquidity run is abbreviated LR. And the next one is high resistance liquidity run, which is abbreviated HRLR, high resistance liquidity run. Now, a low resistance liquidity run, price will cut through this like butter, but a high resistance liquidity run, price is going to have a hard time making its way through the opposing direction, and you'll see what I mean whenever we go through some examples. So in this little tiny depiction that I have right here is representing a low resistance liquidity run. Now you might be asking, how is this an LR? Well, it's because of all of these failure swings that we are creating throughout this move higher. All of these failure swings will get ran through at one point, and when it's ready to go, it's going to go through this quick, right? You see this as a trend line. Retail traders are seeing this and trading this like a trend line, and whenever it's ready to break, it's going to cut through it like butter. Now right here, this little depiction right here is representing a high resistance liquidity run. Whenever we turtle soup a high, and we will get into the turtle soups and how they start every move in the next module, and then we get this displacement lower. Price is going to have a hard time getting through up here because of the breaker blocks, which we will be going through in another module to get to this overall draw on liquidity, which is up here. So this right here, whenever you see a turtle soup, it is representing a high resistance liquidity run. So right here we are on the hourly chart, and this is going to be representing a high resistance liquidity run within the low resistance liquidity run. So right here with this high, you see that we turtle soup this high. So now this right here, this high is going to be acting as a high resistance liquidity run, and we are going to have trouble getting up to this high because of the lower time frame breakers. But if we take a look right here, we can see that we have a failure swing, failure swing, failure swing, failure swing, failure swing. Now, when price runs these lows, it isn't just going to run these lows. It is going to want to take all the liquidity that is resting beneath this low, this low, this low, this low, and the overall draw, which is right here at this low. So what do you notice? Take into account what you learned from the last module. When we take this low, where do we go? We go straight into internal liquidity, right? And the bodies hold it, bodies tell the story, wicks do the damage, and then we deliver to this overall draw on liquidity, which was the low resistance liquidity run. And if we take a look right here, we can identify it as a trend line. Right here, failure swing, failure swing, failure swing, and a failure swing with these two lows right here. And then after we take this overall draw on liquidity, this right here will no longer act as a high resistance liquidity run. Why is that? Because we've already taken the overall draw on liquidity, which was this low, within the LR. So now this high is going to act as the overall draw on liquidity, and as you see, we no longer hold that as a high resistance liquidity run. We go right through it. So let's move on to another example. Now here we are on the 15-minute chart, so we can start to identify intraday low resistance liquidity runs. What do you notice throughout this entire chart right here? We have a bunch of failure swings here, 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 and then we have this one before the turtle soup up here. Now, I want to get this out of the way now. This is a 3 drives pattern right here. A 3 drives pattern means we are engineering liquidity. All of this liquidity right here is being engineered with this 3 drives pattern. Let's go over that right now. So a 3 drives pattern is whenever we have one drive up, then we come down, we have a second drive, and then we have another come down, and then we have a third drive through this high, and now we have engineered this low resistance liquidity on the lower time frames, just like right here. So if we head down to the 5-minute chart, you'll be able to see this in greater detail. But right here we have all these failure swings that I marked out on the 15-minute chart, and right here we have that 3 drives pattern. Now what do you see? We have failure swing, failure swing, failure swing, failure swing. Now what happens on this third drive higher? We get that displacement lower, and then we cut through all of these lows like butter. We go straight through them. So right here is another example of a high resistance liquidity run in a low resistance liquidity run on the reversal. So what do you notice right here throughout this move lower? Failure swing, failure swing, failure swing, failure swings, all these failure swings throughout here are creating what? A low resistance liquidity run, which can be identified by this trend line. So what is happening whenever we are taking all these lows? A high resistance liquidity run engineers liquidity for us to get a reversal to go higher. And what do you notice whenever we take that first failure swing right here? We cut through this like butter and go to that external draw on liquidity. So right here we are having a high resistance liquidity run to engineer that low resistance liquidity run. On arrival, whenever we are ready to go, we go quick. So another thing I want to go over on why this would be a high resistance liquidity run to get back down to this low whenever we show that we are ready to go to that external draw is because look at how many breakers we form whenever we finally get through these highs. We have all these breakers throughout here. This high here, this high here, this high over here. All of these breakers are going to make it hard for price to return back down to this low. And after we hit this overall draw on liquidity, it is fine to take it back down to this low because we have hit that external draw on liquidity. But whenever we are in a low resistance liquidity run, you do not want to be taking shorts to try to target this low down here because price is going to have to cut through all of this price action to get down to this low. Whenever we take that first high, we have nothing holding us back from cutting through this price action. But down here, we have all of these breakers. That's what makes this low a high resistance liquidity run. So here we are on the NASDAQ 5-minute chart. What makes this a high resistance liquidity run to get back up here? We have all of these breakers, right? Bearish breakers are these down close candles holding price to go lower. But whenever we hit that overall draw on liquidity, you are okay to take it back up to this high. But as you see over here, it takes us a while. We get a push up and then we come the entire way back down, creating a high resistance liquidity run. And a high resistance liquidity run, whenever we turtle soup a low, the bodies should not close below. That is whenever you know that should be a protected low whenever we get that displacement higher. And then what do you notice here? We create another high resistance liquidity run whenever we take this low because of all these breakers throughout here. Whenever we close above this high right here, this is now a breaker block. And whenever we get into the breaker block module, you'll understand why this is one of the most algorithmic PD arrays there is. So this right here, this low is now a high resistance liquidity run to here. And then what do you notice? We have all of these engineered highs and price cuts through it like butter whenever we are ready to go. So here we are on the 15-minute NASDAQ chart. And once again, we have a high resistance liquidity run whenever we take this low. Notice the bodies do not close below here. And what do you notice to the left? Once again, we have a low resistance liquidity run lying within here. We have all of these failure swings throughout here. And then as soon as we run the failure swing high, we go straight to that overall draw on liquidity. So whenever we make our way up finally to this high that's the draw on liquidity, what do you notice? We do not take this overall draw on liquidity, and we do not have to. We do not always have to run the actual draw on liquidity for that day. We can create these equal highs because what do equal highs mean? It means that people think this is resistance and retail thinks that this is resistance. So they are going to be shorting here and putting their stops and jamming their stops above here for price just to run through this like butter whenever we are ready to go. Because what do you notice over here? We create a low resistance liquidity run whenever we are ready to go. We go quick. Right, we have all of these failure swings throughout here. We have a failure swing up here that failed to take that failure swing at the top right here at these equal highs. So we have 1, 2, 3 equal highs, and now we are creating a low resistance liquidity run throughout here. And when we are ready to go, we go quick. So what I want you to understand whenever we create these equal highs is the market is going to want to target these equal highs. Whenever we create equal highs, they can either be an SMT or they can just be a target for later on whenever the market is ready to run all of these stops here. At this example, we did not create an SMT, so the market was engineering even more liquidity for when it is ready to go. But as you see throughout here, we cut through all of these failure swings like what? Butter. You are taking your partials throughout all of these failure swings. So another thing I want to add to this is a bullish 3 drives pattern, because I forgot to add that. So that is going to be 1 drive down, a come up, another drive down, turtle swooping this low, another come up, and then a 3rd drive down, creating a low resistance liquidity run and a high resistance liquidity run. So I hope you understand what a high resistance liquidity run is right here compared to a low resistance liquidity run. A low resistance liquidity run is identified by failure swings in the market, and then the market is going to run them like butter, and then the market is going to have a hard time getting back down to lows for a high resistance liquidity run. Or whenever we have a bunch of failure swing lows, that is a low resistance liquidity run to the downside. And high resistance liquidity run to the upside is whenever we turtle swoop highs and create breaker blocks. So let's get on to the next module.